Shares of GameStop now 123 and change, another record high, up more than 450% to start the year.
Situation is the craziest I think I've ever seen. Usually you have a short squeeze and it goes up, but this one keeps going.
Recently, a company called GameStop made headlines as its stock price surged by 2000% in just 1 month. That's phenomenal. Of course, people made a lot of money, but some big corporations lost billions. Total loss because of this stock price movement is $70 billion or 5 lakh crore in Indian rupees. All this happened because of one social media platform called Reddit. This is a story where social media waged a war against Wall Street, and guess what? Social media won it. The stock in the news, GameStop, is an American video game retailer. It sells video games through its 5,500 physical stores spread across America and other countries. Fundamentally, there is nothing great about this company. GameStop's business model is dying. In a world dominated by e-commerce, GameStop's offline retail business is losing steam as people can just pay online and download games. GameStop lost $795 million in 2020 and it is closing down its stores. According to its third quarter earnings report from December, GameStop sales declined 30% from previous year, and that was during pandemic, when video game industry experienced months of increased revenue as Americans stayed home and played games because of lockdown. Meanwhile, digital sales for games reached all-time high. In August 2020, something interesting happened. An activist investor, Ryan Cohen, has invested $76 million in return for 9 million shares of this company. He became a board member of the company and advised GameStop to shift its focus from brick and mortar stores to building an e-commerce website for selling video games to keep up with the market. That was a paradigm shift. Company's stock price rose by 13% on the day this announcement was made. But the phenomenal rise in GameStop's stock price can be attributed to something called short selling. We will get to it in a minute. After coronavirus detected in early 2020, whole world went into lockdown. People started working from home and many people lost their jobs. One effect of all these events is that people suddenly had a lot of free time. Many people started stock trading. It's kind of become a passive income for many youngsters. Data shows that in US alone, 10 million trading accounts were opened in 2020. Stock trading applications like Robinhood added millions of new customers, mostly youngsters. Trading volumes saw a huge spike during this time. It was totally a new trend. People previously not so active in stock markets are now actively trading in stocks. It also means that these young traders can now interact with each other through social media platforms like Reddit. Reddit is a social media platform where like-minded people come together and discuss about everything like movies, politics, conspiracies, etc. through subreddits. A subreddit is just like a Facebook group where people can join the group and interact with each other. One of these subreddits is Wall Street Bets. Wall Street Bets is a subreddit where stock traders come together and discuss about stock markets. They share ideas and decide which stock to buy. These forums are a great place for people to collaborate, but sometimes they can turn dangerous too, like it happened in case of GameStop. So, what exactly happened? To understand that, we have to know what a short sell is. If you have watched the web series Scam 1992, you must already be knowing what short sell is.
मेरे को कुछ समझ नहीं आ रहा है. जो शेयर है ही नहीं मैं उसे बेच कैसे दूं? उसे शॉर्ट करना बोलते हैं.
When we think about stock markets, we are always under the impression that profits can be made only when the stock price goes up. But in fact, you can make profits even when the stock price goes down. This method is called short selling. Let's understand how it works. In a normal transaction, you buy a stock at certain price, say 10 rupees, and if the price of that stock goes up to 15 rupees, you will sell it, and the difference of 5 rupees is your profit. Pretty simple. In stock market, you can do it other way around. You can sell it first and buy it later. Let's understand with an example. For our example, we'll assume that Curious Monk Limited stock is trading at 10 rupees and you feel that company is performing very badly and its stock price will go down in future. So, You can now go to your broker and borrow a share of Curious Monk Limited with a promise that you will return it back in 1 week or 1 month. It depends on the contract you enter into. Now you can go to the market and sell this stock at 10 rupees and you will immediately receive this money into your account. Now assume that as you expected, the price of this stock has gone down to say 6 rupees. Now you will buy this stock at 6 rupees and return it to your broker, of course with some interest. Transaction closed. You sold the stock at 10 rupees and brought it back at 6 rupees. The difference of 4 rupees is your profit. This is how money is made in stock markets even when the stock price falls. In short, this is short selling. In the same example, now let's assume that you sold stock at 10 rupees and instead of going down, stock price gone up to say 14 rupees. Now the stock price is moving in the opposite direction, but still you have to buy the stock at 14 because you have to return the same to your broker. In this transaction, you are making loss. You sold the stock at 10 and buying it back at 14. Your loss is 4 rupees. So in short sell transaction, you make profit when stock price falls and you make loss when the stock price goes up. As there is no limit on how higher the price of the stock can go, the amount of loss you can make on short selling is unlimited. Many stock traders involved in short selling transactions. They sell millions of shares of a particular company and buy them back once the stock price falls. In September 2019, one of the Wall Street Bets member, Keith Gill, noticed something interesting about GameStop and started sharing his analysis on Wall Street Bets and on his YouTube channel called Armchair Investor. He was recommending people to buy this stock. Although company is closing its stores, it had lot of cash on its balance sheet and it can easily pay off its debts with that. During the same time, GameStop entered into a contract with Microsoft to sell its Xbox gaming consoles. It's a great opportunity for the company. Through his research, he realized that there is still a lot of demand for physical game stores and that means increased revenue for the company. During this time, GameStop was trading at around $4. Keith himself invested $50,000 in this stock. Many people agreed with him on Wall Street Bets and some of them noticed something more important. 137% of the GameStop stock was held in short position. That's more than the number of GameStop stocks in existence. That means 137% of the market is betting that stock price will fall. But that's highly unusual. It turned out that some hedge funds collectively shorted this stock to influence the market and bring down the price, ultimately to make profits. Around the same time, another article published in Wall Street Bets titled Bankrupting Institutional Investors. It stated that hedge funds are highly exposed. They are heavily shorting the stock. But if the stock price goes up, their losses will skyrocket. Wall Street Bets loved this idea. They wanted to defeat hedge funds in their own game. Members of Wall Street Bets started buying the stock. Slowly, it became a movement. More and more people started buying the stock, which made the GameStop stock price to skyrocket. You see, when price of a stock starts rising, people who shorted the stock will start buying the shares from the market to limit their losses, because higher the stock price goes, more will be their losses. Same thing happened with hedge funds. They were losing billions of dollars, so they started buying the stock in the market. If you see, members of Wall Street Bets are buying the stock. Even hedge funds are buying the stock to cover up their losses. Everyone in the market is buying the stock. Suddenly, there was a lot of demand for GameStop shares and obviously there was not enough supply. This event had a kind of multiplier effect and GameStop's share price went up exponentially and finally hit its all-time high of $500 per share. That's 8,000% rise from its original price of $4 per share, which is beyond anyone's imagination. This phenomenon is called short squeeze. Keith Gill, who invested $50,000 in GameStop shares in 2019, made a profit of $48 million. However, this move was unsustainable. After the stock price hit all-time high, this movement lost its stream. Stock price started to fall and currently the stock is trading at $63 as I'm recording this video on 5th February. After a dramatic move, GameStop stock is moving towards its intrinsic value and it left hedge funds in huge losses. Wall Street Bets became most popular subreddit. Its members had increased from 5 million to 8.7 million in a matter of weeks. Okay, let's analyze this. The whole drama around GameStop Is it just another event in the stock market, or is it something more? Why young traders hate big institutional investors like hedge funds? I think it is more philosophical. They wanted to make a point here. We know what happened in 2008. The whole housing crisis led whole world into recession. It took almost a decade for us to recover. All this happened because of some big institutional investors took risky bets with investors' money. When they finally lost, government came for their rescue. But people behind these scams lost nothing. In fact, they made millions. Ultimate loser was common man. People lost their jobs, families lost their homes, and debt burden was a bonus. Till now, an individual investor never had the power to go against big corporations, simply because they are too big. But alone we can do so little, but collectively we can do so much, and we have a practical example here in the form of Wall Street bets. Maybe this is the first time when social media and financial world came face to face. We can call it a digital protest against hedge funds. This movement didn't stop here. All around the world, stocks with highest short percentage have seen a spike in their price. The case of GameStop shows us how financial world is evolving day by day and what role social media can play in it. Stock markets have always been filled with uncertainty, mainly because there are too many factors affecting it, and I think a new factor is added to this list, and that is social media. So that's the video, guys. If you like my content, consider subscribing to my channel, and don't forget to smash that bell icon to be notified every time I release a new video. Thanks for watching. This is Curious Monk signing off.